the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares moved higher to track advances in Asia today. So if we look at the Straits Times Index, it was up 0.42% at 4,225 points at about 2:34 p.m. Singapore time. And we're looking here at a value turnover of some 937 million Sing dollars in the broader market. Now, the closing numbers, we do have them right here, so let's take you through them. So the STI, as we shared with you in the news earlier, up 0.55% at the close. We're looking at 4,231 points. Now, in terms of value turnover, that is 1.65 billion Sing dollars. Gainers outnumbered losers 427 versus 164. Top advances for today, we've got for you DBS, New Incorporation USD, and iFast. And top decliners, we have here ST Engineering, Asus, and Penguin International. Well, in terms of counters to watch, we have DFI Retail Group because the supermarket and retail store operator announced yesterday that its underlying profit rose 38.9% to $105 million for the first half ended June. Now, elsewhere from how shares of Japanese and South Korean automakers surged after US President Donald Trump announced a deal in Tokyo that includes tariff reduction on Japanese auto imports, to how Alibaba Group today announced an open-source AI model for software development that is said to be its most advanced coding tool to date. We've got more international and corporate headlines in focus. Plus, how Japanese Prime Minister Shigeru Ishiba is reportedly set to announce his resignation by the end of the month. Now, he has since denied the news. But let's break down all of these developments with Abhilash Narayan, investment strategist at HSBC Global Private Banking and Premier Wealth. He joins me on the line. Abhilash, welcome back to the show.
Good to be back.
Well, just running out of breath talking about the slew of developments going on in markets today. So many things. But let's start with global news this time around, Abhilash. Tokyo stocks rallied with the yen, the US and Japan finally hammering out that deal to slash tariffs, particularly those on Japanese car exports. So Trump said officials have agreed to a massive deal, and that would include a 15% tariff on imports from Japan, down from the previously threatened 25%. How have investors reacted to the news, along with deals inked between the US and the Philippines and the US and Indonesia?
Absolutely. I think it's the biggest development we've seen in the past few days. And to be honest, the U.S. and Japan trade agreement, came well ahead of the 1st of August deadline and, earlier than what some of the market participants expected. Now, as you mentioned, the tariff has been reduced from 25%, which was imposed earlier, to 15%, which is broadly in line with our expectation that most countries should see anywhere between 10 to 20% tariffs. President Trump also announced that Japan has committed to invest around $550 billion into the U.S. Now, I think the key thing, as you mentioned, was the reduction in tariff for Japanese automaker companies, because, if we look at the data, about 80% of Japan's trade surplus is driven by, export of automobiles or automobile parts. So relief on that bit was actually, very, very important for the market. So, Japanese equity markets are up about 3% today, driven obviously by a surge in automaker prices. And I think if we take a step back and take a broader look, we've seen deals being agreed with Indonesia, with Philippines, and now Japan, right? And that's giving investors a bit more confidence, a bit more optimism that finally, we'll have some clarity around tariffs, and then businesses can sort of put this uncertainty behind them and keep investing and focus on their fundamentals.
We'll talk about whether that brings more optimism for automakers in South Korea as well later on in the conversation. But let's go back to the Singapore stock market as usual. How far did STI track regional movements today? Any surprises when it comes down to the biggest movers?
Well, I mean, as you mentioned, STI is up around 0.55% today, which is less than the move we have seen in Japanese stocks and several other Asian markets. But to me, that's not a surprise, right? Singapore has been an outperformer since start of the year. So if you go back to April, Singapore was handed 10% tariffs, which were much lower than a lot of other countries, and that sort of led to resilience in Singapore equities. And if I look at the year-to-date performance, in US dollar terms, STI is up around 21% compared to around 12% for global equities. So Singapore equities have outperformed Asian and global equities, and given that tariffs were less of a concern for Singapore as compared to, let's say, some of the other stock markets, the market reaction, we saw that Singapore stocks moved up, but lesser than some of the other countries. That's broadly what you'd expect. So we think that the fundamentals continue to remain strong. So we continue to be overweight on Singapore equities.
And I do want to briefly bring in this as well. We've got official data out just hours ago showing Singapore's inflation remaining unchanged at 0.6% in June, as higher retail prices were offset by lower prices in all other categories. So the June figure, 0.6% for inflation, was lower than private sector economists' median forecast of 0.7%, according to a Bloomberg poll. Any quick thoughts on the latest numbers?
Yeah, absolutely. So I think our base case has been that inflation in Singapore will be quite controlled, quite manageable. So for 2025, we are looking at inflation of around 0.9%, and for 2026, our forecast is around 1%. And I mean, if you just look at the broader picture, core inflation in Singapore, which excludes the more volatile items, right, that's decelerated from around 2.8% in 2024 to 0.6% in the latest print. Now, part of that is obviously driven by some of the factors you mentioned, but also the fact that we should not ignore that Singapore dollar has strengthened significantly since start of the year, and that means that the prices of imported goods obviously become lower because of the increased purchasing power. So we think inflation should remain quite manageable for Singapore, unlikely to move significantly above 1% on a sustained basis, and that's why we think that the MAS is probably going to ease its monetary policy either in sort of the monetary policy meeting in July, or maybe the next one, because with growth being somewhat slower than last year, inflation being under control, and global central banks easing policy, a lot of things are in place for MAS to also ease monetary policy and reduce the slope of the SGD band.
And if we could zoom in on some of the companies to watch, Abhilash, we have DFI Retail Group, because DFI Retail Group, its shares climbed 12.7% to reach its highest price in over 3 years in early trade today, on the back of the fact that its underlying profit went up by 38.9% on the year to $105 million for the first half ended June. I know you don't comment on individual firms, but how far can this momentum be sustained, really, given the retail sentiment in Southeast Asia right now?
Well, yeah, I don't track this particular company, but I think the results that you mentioned broadly align with what we've been saying, that robust domestic consumption will keep on powering Asian growth. And, since start of the year, there's obviously been a lot of uncertainty around Asian growth because of tariffs. And what we have been highlighting is that if you look at the revenue exposure that Asian companies, be it Chinese, Indian, Singaporean companies, derive from goods exports to US, that's around 3 to 4% of their total revenue. So vulnerability of Asia to US tariffs is not as much as what people fear. In contrast, we've been highlighting that domestic consumption in Asia will be the key driver of the region's growth, be it in Singapore or rest of Southeast Asia, and that's been one of the reasons why we have downgraded Asian growth forecast less than what we have done so in US. So not a surprise. And I think the other thing to keep in mind is we talked about inflation falling in Singapore, and lower inflation essentially means that there's more money in consumers' pockets. And when you add the fact that central banks have been easing monetary policy across the region, again, that's supportive for consumption. So we expect, Asian consumption to remain strong in the second half of this year, as well as 2026.
Okay. And in the meantime, Abhilash, the earnings season is well underway in Singapore as well. We've got ST Engineering, Singpost, Aztec Global, Hutchison Port Holdings Trust having reported their results. How would you assess the latest earnings season as a whole?
Well, it's still early days. I think only 6 or 7 companies have reported. So we need to see more results to sort of get a sense of the trend. But, when we look at Singapore equities, I think it's important to look at it from a sectoral perspective as well. So obviously, if you look at the banking sector, Singapore does have high-quality banks who have shown earning resilience. But I think increasingly so, they are likely to see increased pressures on their net interest margins because interest rates have come down a lot. Now, some of that would be offset by the fact that, they are very, very strong when it comes to wealth management and private banking. So overall, they should be resilient. But, we think that, most of the easy gains are behind us. So we have a neutral stance on the banking sector. But obviously, the forward guidance would be very, very crucial. Real estate sector obviously has been buffeted by higher rates in past. But, we do expect interest rates globally to decline. We've already seen a big decline in interest rates in Singapore, which combined with robust occupancy can mean that REITs can continue to do well. And, on a more positive note, when we look at valuations, despite the strong rally we've seen in Singapore equities since start of the year, valuations are broadly in line with long-term averages, so it's not very, very expensive. So we continue to remain overweight on Singapore as we think it's a high-quality defensive allocation within Asia. But obviously, we need the earnings to come through in the coming few days and weeks.
Okay. Now, across the region, Abhilash, all eyes are on Japan, in particular shares of Japanese, South Korean automakers as well. They surged because Trump announced that trade deal with Tokyo that includes, of course, reducing tariff on Japanese auto imports to 15%. That stoked optimism for a similar deal to be reached for Seoul. What are you keeping your eyes on?
Well, 25th of July. So this Friday on 25th of July, South Korea will hold, high-level talks with the U.S. in an attempt to sort of agree on a tariff level. So we should hopefully get some updates either later this week or early next week. Now, it's very, very important for South Korea because, it holds a very large trade surplus for the U.S. and exports account for around 39% of GDP for South Korea. And in addition to autos, it's a key exporter of semiconductors, smartphones, batteries. So all of those sectors are important. Now, we also have to take into account the performance this year. So South Korean equities have been on a tear. They're up around 31% year to date. Now, part of that has been driven by, catching up of valuations, which were very cheap, hopes from new administration. But, obviously, given that the stocks have rallied so far, earnings are looking somewhat muted. I think the clarity that we get around tariffs will be very, very important for the market performance in the near term. So, for now, we are neutral on South Korean stocks, as we wait for more clarity on the geopolitical and trade-related uncertainties. But if we do get some positive news there, then obviously the outlook could brighten up for South Korean stocks.
Now, let's talk about Japan more specifically because we've seen some automakers, getting some positive movements in terms of share price today on the back of that trade deal. But also at the same time, some uncertainties, it seems, on the political front, given how Prime Minister Shigeru Ishiba is reportedly set to announce his resignation. Now, Ishiba has since, denied the news. So how far will this shadow the positivity on the trade front then?
Well, that's a great point. So we think that, uncertainty is likely to remain there in place for the next few weeks, at least. Obviously, we saw the election results for the upper house recently, and there the ruling party, LDP, did not manage to secure a majority in the upper house. And that led to, expectation that, implementation of policy would probably be slower now because they'll need to work with more coalition partners. There could be, some increased degree of fiscal stimulus. And when you put all of that together, along with the optimism from trade deal, we think a neutral stance on Japanese equities makes sense for now. Now, within Japan, obviously, we do see some pockets of value. So we like the Japanese technology leaders as well as consumption-related stocks, which can benefit from the reflation and, more government handouts and more expansionary fiscal policy. But we still remain somewhat cautious on automakers because obviously the stock prices have jumped a lot. But, they continue to face some fundamental challenges nevertheless.
And further away, Abhilash, Alibaba Group announced today the launch of Qwen 3Coder, which is an open-source AI model for software development that it described as its most advanced coding tool to date. How far should investors double down on the AI theme given the pace of competition, the pace of commercialization, and also the pace of innovation in that space?
Well, we see tremendous long-term opportunity in AI space. Now, if you look at the data, the pace of AI adoption, regardless of which company is leading today, the pace of AI adoption is much faster than what we've seen for prior technology revolutions, be it, the adoption of personal computers or internet. And there's a good reason for that. Most experts say that there will be tangible benefits in terms of productivity as companies and employees start using AI in their daily tasks. The other thing to keep in mind is, as AI becomes more prevalent, the increased efficiency and affordability will mean that the total addressable market will probably increase because costs become more reasonable. Now, as far as China and Alibaba are concerned, obviously we think that the DeepSeek model released in January was a watershed moment, and it made the world realize that you don't necessarily need the fastest chips to develop good AI models. You can do it in a smarter way. Now, we are quite positive on Chinese technology giants and AI-related stocks because, if you look at it, China leads the world in AI publications. Around 70% of AI-related patents in the world are held by China. So we think that the rally we've seen in Chinese tech giants is just starting. Now, in addition to China, we also like the AI and technology-related stocks in U.S. So China and U.S., are the primary focus markets when we are looking at the AI-related sector.
I see. China and U.S. when it comes down to AI. Thanks so much for the insights, Abhilash. That was Abhilash Narayan, investment strategist at HSBC Global Private Banking and Premier Wealth. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.